Let me begin by saying this. When we hear that the $2.8 trillion car market has collapsed, that is not a whisper. That is a roar. That is the sound of an entire empire cracking at its seams. And yet, that roar is not the death knell. It is the trumpet, the blast that calls us to build the new world from the ashes. I stand before you not to shroud us in doom, but to reveal the ignition point hidden beneath the catastrophe. Because yes, collapse is real, devastating, crushing. Fact, automakers globally once approached a total market valuation of nearly $2.8 trillion, and that edifice now shakes. Dealers are sat on mountains of unsold inventory. In the U.S. alone, over $189 billion worth of vehicles now languish in dealer lots, gathering dust and depreciation. The glut is not for days. Many unsold cars have sat idle for 180-plus days. YouTube, we are watching a kingdom in convulsion. But I say to you, every collapse is a catalyst, a reset, a pressure chamber for reinvention. The forces that broke what we knew will shape what we build. The syndromes of crash, leverage, obsolescence, rigidity, complacency, they illuminate the path toward what must come next. Look at history. Look at 2008 to 2010, when the automotive world nearly imploded. Entire car makers teetered on the edge of bankruptcy. Governments intervened to prevent systemic collapse. We learned then that no company, no sector holds immunity from the tides of macroeconomics. Wikipedia +1, but also, and more importantly, we learned that in those crucibles, new leaders, new designs, new business models are forged. So let us not shy away from the carnage. Let us dissect it. Why did this collapse happen? Because markets reached inflection points they could no longer sustain. Interest rates skyrocketed. Inflation gnawed at consumer wallets. The cost of capital soared. Financing that made car purchases accessible, lease deals, loans, credit, dried up. In that vacuum, demand crumbled. Medium because of that, automakers were forced to slash margins, offer ever more incentives, absorb losses until the bottom gave way. Also, consider structural decay. Many legacy manufacturers built their empires on internal combustion, on large production lines, on vertically integrated supply chains. They optimized for scale, not for agility. When the dynamics changed, electric vehicles, semiconductor bottlenecks, software-defined cars, their heavy machinery had inertia. Indeed, the global chip shortage from 2020 onward exposed how fragile these chains truly were. Modern vehicles can contain thousands of semiconductor components. When supply cracks, the foundation trembles. Wikipedia, so the collapse is a message. You cannot outrun obsolescence by clinging to yesterday's strengths. Now hear this. When everything cracks, light pours in. The fracture lines are precisely where innovation will take hold. Imagine the collapse as the grand rupture, and through it, new veins of possibility begin to sprout. Those entrepreneurs, engineers, thinkers who can slip into the cracks, who can reimagine mobility not as cars we own, but as transportation, as a living system, they will draw power from this breakdown. Do not misunderstand me. This is not poetic smoke screening. The losses are real. Jobs will vanish. Factories will sit idle, suppliers will default, creditors will writhe. But that is the crucible from which new forms of collaboration, new ecosystems, new technologies will emerge. Collapse forces pruning, pruning forces growth. I ask you, when the structure that holds your industry, your business, your plan gives way, will you collapse with it, or will you lean into the gap? Because the gap is where the future will form. Let me tell you about what leaning into the gap looks like. It means breaking assumptions. It means asking, why must cars be owned by individuals? Why must they be built in giant monotonic factories? Why must we tolerate waste, underutilization, emissions, inefficiency? From those questions springs radical rethinking, fleet models, shared mobility, modular platforms, battery as service, over-the-air software upgrades. These are the embers in the wreckage, and even today we see hints. In markets now, electrification is teetering from niche to mainstream. Autonomous driving is inching from lab to road. Smart cities demand vehicles that speak to grid, to network, to infrastructure. Commuters begin to envision mobility as a subscription, not a purchase. The collapse is accelerating adoption of these models. In a shaken market, early adopters find space. You might say, Richard, this is all idealistic talk. People have bills to pay, factories to run. Yes, and so your idealism must be anchored in rigorous strategy. You must map the broken terrain with clarity, which parts of your value chain are dying, which are alive, what assets you can repurpose, which partnerships you must forge. The collapse is not a random storm, it is a filter. Your role is to see which parts are toxic and rip them away. The parts that survive will become the seeds of what you rebuild. One more point, collapse is catalytic, not just for industries, but for identity. The institutions of yesterday will lose their grip. Some CEOs will be remembered as dinosaurs, others will reemerge as architects of the future. The way you respond will define your legacy. Will you cling to legacy systems just because they once served you, or will you become unshackled, willing to remake your mission, rewrite your strategy, risk the unknown? So I challenge every leader in this room. Do not wait for stability to return. Do not wait for markets to whisper safe again. The whisper may never come. Instead, provoke the new era yourself. Use collapse as your workshop, your forge, your crucible. Start small. Pilot fleets, software platforms, new distribution models. Fail fast. Learn faster, reallocate your most agile units into experiments, because the moment to wait is past, the moment to act is now. In every breakdown there is a signal, a pressure point telling us where to direct our energy. The world is reconfiguring itself under our feet. Those who stiffen will fracture, those who flex will channel. Collapse is not punishment, it is invitation. An invitation to the bold, the imaginative, the relentless. I conclude this keynote with this truth. Every collapse is a catalyst. It is the universe's way of clearing away fake mountains, of exposing real strengths, of demanding resurrection. What is dead must die. What is alive must rearrange. The question you must answer is, in the crash of $2.8 trillion, will you lie crushed beneath the ruins? Or will you stand in the new dawn, hammer in hand, ready to forge what comes next? The roar will not silence. Let it guide you. And so we arrive at the moment where the death of old systems becomes the soil from which new life will sprout. When the $2.8 trillion car market quakes and fractures, know this: the end of what was is the beginning of what must become. The collapse isn't the final act, it's the intermission. And in this space, the only way forward is to innovate. The collapse is not evidence that mobility is dead, it is evidence that mobility as we knew it must die. The combustion engine-centric rigid assembly line, national supply chains, dealerships as the only distribution points, these legacy systems are crumbling. But in those ruins lie new architecture. We must treat this moment as a blueprinting session, not a morgue. To see how the future already creeps in, look to electrification. In 2024, global electric car sales soared to 17.3 million vehicles, a growth of about 25% compared to 2023. IEA, more than 1 in 5 new cars sold worldwide in 2024 were electric. IEA plus 2 China led this charge. It produced over 12 million electric vehicles in 2024, accounting for more than 70% of global EV output. IEA plus 1 electric car exports globally rose nearly 20%, hitting around 3.2 million units. IEA in the U.S. third quarter of 2025 recorded 438,487 EVs sold, up nearly 30% year over year, pushing EVs to 10.5% of all auto sales. Cox Automotive Inc. These are not fringe figures, they are signals of tectonic shift. But note, many legacy automakers are already stumbling. In the U.S., new vehicle margins are compressing dangerously. Dealers are reporting slimmer spreads, while incentives have exploded. In some estimates, incentive spending is up more than 66%. Digital dealer +1. Some automakers are taking impairments on EV investments. GM, for example, has announced a $1.6 billion charge as it rethinks its EV scale and capacity amid weakening demand. Reuters, even Tesla, long the torchbearer, has recognized margin pressure in recent quarters as it cuts prices to stimulate demand. The Economic Times, these are signals that the old models are under siege. Innovation is not about incremental tweaks. In times of collapse, it is about rewriting the rules. The question is, how do you re-architect mobility so that the next system is fluid, adaptive, resilient? First, shift from product to platform thinking. The old model asked, how many cars can I sell? The new model must ask, how many mobility hours can I deliver? A vehicle becomes a node in a network, not a sold artifact on a lot. Battery as a service, modular upgrades, over-the-air updates, these are no longer optional luxuries. They are essential dimensions. A rigid car chassis built for one powertrain becomes a liability, one built to accept iterative upgrades, software changes, battery swaps, becomes an asset. Second, decentralized production. The collapse exposed how fragile centralized, long-tail supply chains and sprawling factories become when localized shocks, logistics bottlenecks, or component scarcity strike. In 2021 to 2023, global semiconductor disruptions revealed how intimately the auto sector depends on a few nodes of fabrication. A future auto system demands smaller, agile microfactories, regional assembly hubs, flexible lines tuned to evolving demand. The more nimble your footprint, the less vulnerable it is to shock. Third, invert distribution. Dealers have long held the keys to sales, but in a broken market, that model creaks. In its place must rise direct digital channels, subscription models, fleet-based distribution, mobility as a service, peer-to-peer networks. The consumer no longer needs to step into a showroom. Mobility should step toward them through apps, through platforms, seamlessly. Fourth, embed intelligence. Cars become sensors, grid participants, autonomous agents. In a broken market, added intelligence is a differentiator. A vehicle that learns, adapts, predicts, communicates with infrastructure that is no longer just a vehicle, it's a node in a living mobility brain. As cities demand smarter integration, as grids need load balancing, as urban planning evolves, vehicles that are silent participants, not dumb machines, will win. Fifth, embrace circularity. Old systems treat materials as consumables, new systems treat them as loops. Batteries, rare earths, electronics, we must design for disassembly, reuse, recycling. The breakage in markets demands we not build disposable machines, but regenerative assets. Waste is now not just moral, it is capital drain. In this wake, imperatives emerge: be platform-centric, regionally agile, digitally distributed, intelligently embedded, and materially circular. These are not buzzwords, they are structural principles for the next mobility order. I don't pretend this is comfortable. Many will resist. Many will cling to what worked. Many will see marginal upgrades rather than systemic overhaul. But survive you will not on half measures. Those who retreat to the old designs will be swallowed in the collapse zone. Now, some may ask, is the market ready for this shift? Are consumers ready? Yes, in some places faster than we believe. In China, the EV penetration crossed 45 to 50% in 2024 in many months. In European markets, despite policy pullbacks, EV shares held at 20 to 25% of new sales. IEA +2, McKinsey and Company +2 in the U.S. EV share is just beginning past 10%. Cox Automotive Inc. +1 consumers are already choosing electric over combustion when pricing and convenience align. But this maturation will accelerate rapidly if design systems make it seamless, integrated, and value-rich. The collapse amplifies opportunity. What was once fringe becomes baseline. What was once experimental becomes standard. The survivors will not be those who defended past strengths. They will be those who dared to design new ones. So when the industry looks at this crash, hear me, this is not the death of cars. It is the death of the old car economy and the birth of something greater, a mobility ecosystem that is fluid, intelligent, sustainable, resilient. You do not stand before a broken industry. You stand before an industry in metamorphosis. Your role is not to cling to the shell. Your role is to help build the butterfly. Use this collapse not as a curse, but as a crucible. The old dies, new systems take shape, and in those new systems, giants will rise. Let's not mourn what was. Let's write what comes next. And so we come now to the deeper test. When crisis strikes, it does not simply crush your surroundings. It probes your core. It asks, will you crumble under pressure or will you rise in character? In this third keynote, I call on you to understand that crisis tests character, not circumstance. We live in a time when the $2.8 trillion car market, once perceived as nearly invulnerable, now lies in shambles. But that collapse reaches beyond factories and balance sheets. It strikes at identities, at reputations, at convictions. In those tremors, true leaders are revealed, not by what they had built when things were easy, but by what they choose to do while the ground shakes. Let me draw your attention to some stark numbers. Automotive OEMs today are reporting EBIT margins down to around 5.4%, reflecting a decline of more than 40% from their 2021 highs. Bane, that is more than a financial squeeze, it is a test of discipline. Suppliers themselves, once buffer zones, are under pressure too. Their margins are falling, many are facing liquidity crunches. Bane, over the past quarters, the model of complacency has been exposed. The slightest shock cascades across weak seams. Now, imagine a company whose leaders hunkered down, hoping the storm would pass. Imagine one that trimmed its innovation budget first, cut its forward rand, and froze all risk. That company might survive the quarter, but its soul will be hollow. When the world rebuilds, it will lack the muscles to shape the new order. Crisis does not care about your titles. It cares about your conviction. It cares about whether you can continue to think, to create, to reframe. It cares whether you can maintain composure, clarity, courage, because when circumstances rage, character becomes your anchor. In real terms, we have seen entire suppliers falter, even die, because when pressure mounts, they lack adaptive capacity. Entire brands, even those once untouchable, have slumped, not because they misread markets, but because their leadership failed to reorient in time. That failure stems not from bad luck, but from having built nothing deep enough to endure failure. Data from business continuity studies show that 90% of companies that cannot resume operations within 5 days of a disaster fail within the year. Risk and Resilience Hub, that means speed under stress, clarity in chaos, resilience in collapse. Those are the traits that separate life from death in a crisis. It is not sufficient to hope markets recover in weeks. Your character must be ready to shape the recovery. And crisis often demands unlearning. It will force you to set aside ego, abandon sacred cows, question your central assumptions. When that is painful, many retreat into denial. Many double down on what worked yesterday. But crisis punishes stagnation, not risk. The ones who survive are those who can hold conviction when others tremble, who can trust vision when others collapse, who can execute bold pivots when others cling to lifelines. You might ask, is character enough? We need capital, we need assets, we need cash. Yes, all that is true. But capital without character is an easy victim. When banks pull lines, when investors withdraw, character becomes the bridge. It helps you inspire stakeholders, re-earn trust, marshal resources, even in scarcity. Look back at crises in history. Leaders who capitalized on collapse were not those with the biggest war chests, but those with resolve. Think of how some industrial titans pivoted during recessions, or how some companies launched in downturns and rose fastest in the recovery. Their assets multiplied not because money was abundant, but because their character was unbreakable. So when we speak of collapse, know this: the battle is equal parts external and internal. You will lose some battles in supply chains, in demand, in pricing, but you must never lose the core battle, that of identity and purpose. If you emerge from the collapse having lost your reason for being, your brand will limp. But if you emerge with sharpened purpose, you will influence what comes next. Now, here is the litmus test. Under pressure, do you protect your lowest performers, your legacy lines, your sentimental projects, or do you reallocate them, even cut them off, to free resources for what must come? Character is shown in those hard choices. To preserve the whole, you must sometimes kill parts. This is learned, not easy. You will be tempted to retreat, to deliver safe messages, to tone down ambition. The market is inviting you to cow, to shrink, to hunker. Resist that. The loudest voices in crisis are voices of fear, and if you allow them to lead, you become a follower. Instead, lead from your core. Speak honestly, decisively, morally. Keep your team aligned not to what is comfortable, but to what is necessary. Crisis also reveals who your allies really are. When times are easy, everyone will applaud. In collapse, only those who share conviction stay close. Those are the relationships worth keeping. Lean on them, not purely for resources, but for alignment. Character builds trust, trust builds alliances. In the wreckage, shared trust yields far more leverage than temporary capital. The collapse of the $2.8 trillion car market is not just a financial collapse, it is a moral and strategic reckoning. It asks of you, what do you truly believe? What's non-negotiable? What do you refuse to trade for short gains? It forces you to decide who you are when everything else disappears. That is the test of character. I urge you, when calamity strikes, do not shrink behind data, behind caution, behind excuses. Stand forward. Be vulnerable but firm. Admit uncertainty but act decisively. Hold your compass tight even when the storm bends the mast. The world watches not just what you build, but how you build it under pressure. Because when the collapse is done, what remains, what shapes the new, is not the assets or the factories, but the leaders who stood in the breach, those who kept faith, those who held conviction, those who could look at ruin and see possibility, not delusion. Circumstances crumble, character remains. This is your crucible. Rise to it. And so we arrive now at the point where adaptation is not optional. It is the new currency. In a world where the old systems have cracked and crumbled, those who pivot fastest, who redesign in motion, who evolve in real time will not just survive, they will lead. When the collapse of a $2.8 trillion car market rattles the foundation, it reveals vulnerabilities in rigidity, overly lean supply chains, monolithic platforms, vertically integrated silos. Those who tried to hold everything in one piece found that the slightest tremor brought down the entire structure. But adaptation, by contrast, expects the tremor. Adaptation flows with stress. It reconfigures, responds, rebalances. Look at how mobility as a service, MaaS, is rising precisely because static ownership models are failing. The global MaaS market is forecasted to reach USD 328.98 billion in 2025, growing at a CAGR of 14.02%. toward 2030. Mordor Intelligence Shared Mobility is already valued at USD 359.10 billion in 2025 and projected to grow to USD 834.92 billion by 2032. CA with 12.8%. Coherent market insights. The message is clear. Consumers are shifting toward flexibility, not fixed assets. Those who adapt by offering mobility hours instead of vehicles, by selling access instead of ownership, will ride that wave upward. Consider how much flexibility is embedded in digital ecosystems. In 2025, the mobility technologies market is projected to grow at a CAGR of 23.75% from 2025 to 2033. Cognitive market research. Those technologies give us modularity, real-time control, intelligence. They allow us to split formerly monolithic systems into adaptable modules, hardware, software, energy, services. In that deconstruction lies agility. But adaptation must not be superficial. It must be structural. It cannot simply tack digital onto a legacy product and call it transformation. It must recast the core assumptions. For example, instead of manufacturing full vehicles, you manufacture chassis plus modules. Instead of selling powertrain packages, you lease batteries. Instead of treating software as optional, you treat it as integral. You embed upgrade paths, modular architectures, scalable nodes. One clear pivot is to small regional microfactories. The collapse exposed how global supply chains, dependent on long shipments and centralized factories, are brittle under shock. But regional production hubs with modular lines can ramp up, adjust, customize. That means you carry less risk for each node, you shorten feedback loops, you localize resilience. Another pivot is in distribution. Traditional dealerships are failing as the pressure mounts, incentives balloon, margins shrink. But digital channels, subscription services, fleet-as-a-service models, peer-to-peer mobility all offer alternatives. Build your dispatch platform, your API layer, your software stack. Let consumers subscribe to mobility rather than buy it. That shift transforms one-time cash flows into recurring revenue, more stable in turbulent times. Embedding intelligence is also adaptation in its purest form. Vehicles now must be not dumb machines, but nodes in a network. They must learn, sense, act, coordinate. They must talk to infrastructure, to grids, to traffic systems. In the autonomous and connected domain, the market for autonomous vehicles is projected to surge from USD 60.3 billion in 2025 to USD 449 billion by 2035, a CAGR of approximately 22.2%. The future of commerce, when machines carry intelligence and coordination, adaptation moves from reaction to anticipation. When you embed intelligence, you also gain optionality. You can push over-the-air updates, reconfigure features, shift modules, introduce subscription features, change monetization paths after deployment. A static car cannot adapt post-sale. An intelligent software-defined vehicle can evolve for years. Circularity is likewise adaptation. Materials, battery packs, rare earths, electronics, all must be conceived as loops, not consumables. The collapse phase demands that waste be turned into value. Design for disassembly. Use secondary materials. Recycle. Refurbish. Adaptation in materials conserves capital, reduces risk, and aligns with emerging regulation and sustainability pressures. Adaptation also demands dynamic partnerships. You cannot adapt alone. You must make alliances across energy providers, infrastructure operators, cities, software firms, telecoms. The new mobility order is a complex ecosystem. Those who build bridges, who integrate across silos, who borrow capacity will adapt faster. In collapse times, the networked adapters outpace the lonely titans. But adaptation puts a burden on leaders. They must tolerate mess, ambiguity, iteration. They must fund experiments, accept failure, kill the unfit quickly. They must decentralize decision power, empower microteams to sense local signals, to execute locally. When the ground is shaking, lift your central weight and let nimble units dance. Let me stress, adaptation must be anticipatory, not reflexive. Those who only adapt when shock hits are one step too late. You must map scenarios ahead, where regulations will go, how energy systems will evolve, how cities will demand integrated mobility. You must run scenario simulations daily. Then when the shock comes, your model already holds counters. To illustrate, consider how some mobility platforms now integrate multimodal scheduling. Ride, bike, scooter, public transit, all in one app. That is adaptation at the system level. It turns fragmented mobility into seamless flow. That is a shift from product to orchestrator. As MAS grows, players who can manage orchestration of software, vehicles, infrastructure will dominate. A platform that connects, adapts, predicts, adjusts will thrive. Another stark data point: global vehicle sales growth in 2025 is forecasted to be only 2.7%, reaching 98.7 million units. Denton's that meager growth shows that demand expansion alone will not save you. You must extract more value from services, software, recurring models. That is adaptation in revenue architecture. Adaptation also means rethinking customer relationships. In a collapsed market, trust is precious. You cannot rely solely on one-time sales. You must cultivate engagement, feedback loops, upgrades, feature packs. You must stay connected to users. That connection gives you the agility to pivot intelligently. Think in layers: physical layer, vehicle, battery, hardware, software layer, features, updates, controls, services layer, subscriptions, mobility access, infrastructure, energy layer, charging, grid interaction, and data layer, analytics, prediction, orchestration. Adaptation means designing each layer to be modular, replaceable, upgradable. If one layer fails, the rest can reconfigure. When the collapse shakes your industry, adaptation lets you phase transitions. You can phase out combustion lines gradually, shift modules to electrification, deploy software-first platforms, pilot shared fleets. The broken old part need not take everything down. The adaptive core can survive and expand. I will not pretend this path is without friction. Many will resist. Many will cling to sunk assets, to fixed factories, to existing contracts. Many will demand certainty in uncertain times. But adaptation courts uncertainty. It dances in the unknown. That is its strength. As the collapse flows outward, adaptation builds inward. The companies that adapt first, hardest, structurally, will not just weather the storm, they will drive the next wave. In the ruins of the old market, the new modular, intelligent, service-based mobility ecosystem will rise, and those who adapted will already be in place, already connected, already evolving. So hear this: when circumstances feel like avalanches, adaptation feels like survival. When systems crumble, adaptation is your scaffold. The old currency, size, scale, legacy, vertical stack, is fading. The new currency is adaptability, modularity, intelligence, flexibility, optionality. The ones holding that currency will lead. Let your strategy anchor in adaptation. Let your teams think in modules, not monoliths. Let your assets be upgradable. Let your business model morph. Let your tech stack flex. Let your partnerships expand. Let your purpose guide your pivots. Because in the ruins of the $2.8 trillion collapse lies the blueprint of what must come next. It is not defined yet, but adapters will draw its lines. The future will not ask who defended the old. It will ask who built the new. Adaptation is how you become that builder. And so we arrive at the summit. The future belongs to the bold. When the $2.8 trillion car market implodes, the greatest opportunity is not in salvaging the past, but in daring to conceive what replaces it. In the roar of collapse, boldness is not reckless, it is the compass by which new worlds are charted. Picture this. In 2024, global electric vehicle sales exceeded 17 million units, pushing EVs to more than 20% of new car sales worldwide. IEA, in 2025, analysts forecast that figure will rise even further. Some expect more than 20 million EVs sold globally, approximately 17% jump. Reuters China's NEV sector already commands more than half of its new car market, its plug-in vehicle share reaching nearly 48% in 2024. Wikipedia, these are not just statistics, they are signposts pointing to a world in which what was once bold is becoming baseline. But boldness does not mean blind faith. To carve your path in the wreckage, you must combine daring with reason. You must see opportunities others dismiss. You must take risks others fear. The future will not simply reward conservatism. It will reward those who gamble for change. Boldness means acting today for tomorrow. It means that while others whisper wait for markets to stabilize, you are already building trials, piloting models, forging alliances. You move before permission is granted. Recall that the mobility market is projected to nearly double in value by 2035 in the US and Europe as the nature of transport itself becomes redefined. Deloitte, the profit pools will shift. The value lies not in steel and powertrains, but in software, orchestration, services, and integration. To be bold is to stake a claim in those pools before they are fully visible. In that claim, there is risk and reward. Boldness means you do not simply follow trends, you set them. You do not wait for regulation to steer you, you design with it in mind. You do not wait for infrastructure to catch up, you build infrastructure. You do not wait for networks to emerge, you create them. But boldness also demands humility. It demands that you listen to markets, to metrics, to feedback. You pilot with intention. You scale what works. You abandon what fails. Boldness is not dogmatism. It is disciplined iteration. Let me give you a concrete image. A bold company in this collapse does not merely launch an electric car. It reimagines the full stack: energy, charging, software, services, fleet operations. It does not sell hardware and walk away. It remains embedded. It monitors usage, learns from data, adapts in software. It turns customers into partners, assets into networks. Boldness means you see the collapse not as damage, but as erasure of constraints. As old rules dissolve, you can redraw the boundaries. You can reach into markets once inaccessible. You can test modular product lines. You can tease new revenue models, battery leasing, feature subscriptions, mobility access, data monetization. Boldness also requires resilience. You will be knocked back. You will face criticism, skepticism, resistance. You will make mistakes, but the bold do not abandon vision at the first sign of suffering. They recover, recalibrate, advance. Their willingness to endure in uncertainty is what makes them heroes of transformation. Look at how many automakers have pledged to phase out internal combustion entirely. Volvo, GM, VW, others, with timelines set by 2030 or 2035. Wikipedia, that is bold. But even beyond pledges, the true test is in execution. Boldness means you put your resources behind it. Boldness asks, where will 70% of new vehicles be by 2040? Many projections suggest BEVs will dominate, perhaps making up 70% of new car sales globally, with hybrids filling much of the remainder. Roland Berger, to bet on anything else is to bet against momentum. Boldness means you treat policies, regulations, public sentiment not as constraints, but as conduits. Bold players will shape policy, align incentives, co-design with cities, energy systems, grids. They will help author regulation rather than react to it. When the dust settles, boldness will distinguish not just which companies survive, but which reshape the world. The future will not reward cautious incumbents, it will reward audacious builders. The next decade will not be a replay of the last, it will be a shift in paradigm. So I call on you, don't stand on the margin of the coming mobility revolution. Step into the arena. Let fear grip your mind for a moment, then release it. Let uncertainty test your resolve, then sharpen it. Let the broken market scare most, and let that be your advantage. Boldness is not arrogance, it is responsibility. It is recognition that the future will be written by those who act. It is the embodiment of purpose. And so we close our journey. Collapse was the prologue. The chapters ahead belong to those who would not shrink, but who would dare. The time is not after stability returns, it is during the instability. The moment is not when the world is safe, it is while it trembles. Rise then in boldness. Build what they say cannot be built. Dream what they say cannot be dreamed. Act what they say cannot be done. Because the future belongs not to the cautious, but to the bold.